The 1929 stock market crash is often remembered as a sudden disaster, a single day when fortunes disappeared and the Great Depression began. But the truth is far more complex. The crash was not an overnight catastrophe. It was the result of nearly a decade of unchecked optimism, speculative excess, and borrowed money. Confidence, as it turns out, is fragile, and when it evaporates, even governments and central banks cannot instantly restore it. Understanding the crash without panic means looking at the years leading up to it, not just the days when the market fell. The 1920s were a period of extraordinary prosperity in the United States. Cities were growing, technology was transforming daily life, and industry was booming. Automobiles, radios, and refrigerators made life easier. Wages were rising, and many Americans believed in an endless economic boom. But beneath the surface, serious weaknesses were building. Farmers struggled with falling crop prices, wealth was concentrated in the hands of a few, and banks lent money freely without sufficient oversight. The stock market became the centerpiece of this exuberance. Between 1921 and 1929, the Dow Jones Industrial Average jumped from 63 to 381 points, a six-fold increase. Ordinary Americans, not just financiers on Wall Street, were buying stocks, often on margin. With margin trading, investors could put down a small fraction of the stock's value and borrow the rest. This leverage amplified gains when prices rose but created a ticking time bomb if the market slipped. One small drop could trigger mass selling, and that is exactly what happened. Even the smartest people of the era were caught up in the euphoria. Bankers reassured the public. Economists proclaimed stock prices had reached a permanently high plateau, and politicians promised prosperity for everyone. Yet, signs of danger existed. The Federal Reserve raised interest rates to cool speculation, but it was too little, too late. By late 1929, cautious investors began selling quietly, rumors circulated, and then panic took over. On Black Thursday, October 24th, millions of shares were traded in a wave of fear. Banks tried to stabilize the market, temporarily restoring confidence. But the following week, the selling returned with far greater intensity. It's important to note that the crash itself did not cause the Great Depression. It sparked it. The deeper disaster was a fragile financial system and policy missteps that followed. Banks had lent recklessly, and when loans defaulted, thousands of banks failed. Millions of Americans lost their savings. Credit froze, businesses collapsed, and unemployment soared. Protectionist policies and adherence to the gold standard prolonged the economic collapse. While some countries abandoned gold and recovered more quickly, the U.S. held on until 1933, deepening the crisis. The Depression reshaped societies and politics around the world. In Germany, economic hardship fueled extremist movements. In the U.S., Franklin Roosevelt launched the New Deal, creating social safety nets, public works programs, and financial reforms like the Securities and Exchange Commission and the FDIC. These measures were aimed at restoring trust in a system that had failed its citizens. The lessons were clear. Without safeguards and confidence, capitalism can implode, and ordinary people bear the brunt. The relevance of 1929 extends far beyond history books. Financial bubbles continue to form in modern markets. Easy credit, speculative manias, and overconfidence in continuous growth appear in tech booms, cryptocurrency spikes, and housing crises. Patterns repeat because human behavior, greed, fear, and denial does not change. The warnings from 1929 remain valid. Complacency and blind faith in rising prices are dangerous. So what does this mean today? Protecting wealth is not about timing a crash or chasing quick gains. It's about understanding the cycle of boom and bust, diversifying assets, and prioritizing durable value over speculation. The 1929 crash teaches resilience. Those who prepared, diversified, and stayed disciplined survived, while those caught up in the frenzy lost everything. Financial education and caution are the most reliable protections when markets falter. In the end, the crash of 1929 is not just a story about stocks or banks, it's a mirror for our present. Markets will always fluctuate, bubbles will form, and crises will come. History doesn't repeat exactly, but it rhymes. The key lesson is timeless. Don't rely on luck, don't confuse speculation with wealth, and always protect yourself with knowledge. Confidence in the system can disappear overnight, but wisdom, preparation, and understanding endure.